Have you often wondered what in the world does short selling mean? And why are we hearing about that in the news these days? Well, if that's of interest to you, stay tuned. I have some answers for you. So, understanding long and short. Now, this is where people have a little bit of trouble here. People can understand the concept of long pretty easy. Just remember, buy low, sell high. Not really hard to understand. I want to buy a stock at 10, sell it at 15. Woohoo! That is what we call going long. But then there's another part of this whole equation, and that's where sometimes people get the old deer in the headlights look, because it may be a little hard to understand at that point. So there are two types of transactions in the stock market. Buy, okay, and sell. Woo, yeah. If an investor wants to buy low and sell high, then what we do is we say that investor or trader or fund or whoever's doing the buying, they are long. So if you watch any of my videos and you say I'm net, and I say that I'm net long right now, that means that the things that I'm doing, I'm hoping will go up in value. Okay? And that one's pretty easy to understand for people. Here's where it gets a little complicated. If an investor wants to sell high and buy low, then that investor is short. And you're like, okay, how can that happen? Well, I'm going to tell you how that can happen. So putting a long together, and this, I should be able to go through this pretty quickly because it's not all that complicated, and it's what most market participants do. If you're in a mutual fund, a 401k, a Roth IRA, or some kind of a retirement plan, or if you just have your own portfolio, it's not all that hard to understand. And the markets are really geared towards it to go up. And even though we have some really bad downtimes, overall, most investors are long in the market. But let's just go through that to see how it works. So when you're long a stock, it means you want to buy low, sell high. You enter the investment by paying the current ask price. Okay. Now, it'll come up just as a price along the ticker, or you'll get a confirmation from your broker saying you bought at this price. But at the moment when you entered into that investment, your price was the ask price when you bought. So then, let's say at some point in the future, you may decide that you want to sell that stock. Okay? So when you sell, the price that you will receive is the current bid price. Again, for you, it's just, hey, I got out at 20 or I got out at 15. But as that trade was being transacted, when you sold, it was done at the bid price. Here's an example. You want to buy $10, a $10 stock, and you do that on January 1st, 2021. Now, good luck doing that because the markets are closed. I'm just trying to use this as an example. And at the time, whether it's right when the market opens or at some point during the day, when you enter your order, you log into your computer, you log into your brokerage account, and you say buy. You hit the button. At that moment, your trade gets sent through the system. The ask price is $10. And the bid price might be $9.95. There's a 5-point spread or 5-cent spread there. Now let's say some point in the future, 4 years later on January 1st, the stock is now at $20 per share. Ooh, you doubled your money in 4 years. Good for you. Okay, so on January 1st, when the market's closed, you decide that you want to sell that stock. When you go in to place that transaction, the ask price might be $20.05, where the bid price is $20. And that's the price you will receive when you go ahead and sell the stock. But congratulate yourself, you just made a 100% return. You bought a stock at 10 and sold it at 20. what could go wrong with that? Okay. So now here's where it gets a little more complicated. Understanding short selling. And I teach classes on these things, and I'm always asked this question the first time. That you buy first and sell next when you're going long, or you buy to enter when you're going long, and then you sell to exit when you're getting out. That's easy. No problem. But when I say you sell to enter, and then you buy to close, and hands go up all over the place saying, how can you sell something you don't own? And then to make things even worse, I answer a question with a question. My usual response is, well, how can you buy something when you don't have the money? Okay? We have these things called credit cards. You don't have to have all the money now. We don't have to come up with a whole price for our house right now. We just have to come up with a part of it. But we can still live there and we can still use it and then spend the next 15 to 30 years paying for it. So if you believe that you can do that, you can buy things when you don't have the money, do you think it's even possible that you can sell something when you don't own it? And usually the response I get back is, well, I don't really understand it, but yeah, I'll go with you for a few minutes on that. And then now I launch into my spiel about short selling. And believe me, folks, this can be a little hard to understand. Okay, it can be confusing and it may require an aha moment. And I'm not exaggerating. There's one time I had an 8-hour conversation with somebody trying to explain short selling to them. And they never did really understand it by the time we got done. It didn't click for them. I was using hand signals, I had puppets, I was drawing things out, and it just didn't make sense. And so you might be one of those people. I'm not trying to insult you. I'm just saying this might be new to a lot of you, and you're like, huh? I just don't get it. So I'm trying to use some real world examples. I use some in the class that I teach where I talk about this. And I'll use, hopefully, what I think would be an easy to understand example here. But you're going to have that, the heavens will part and beams of light will come down and the angels will sing. There will come a time where you suddenly understand this. And then what I'm hearing most of the time about what's happening right now is they just, in very simple terms, you buy low and sell high. Well, when you go short, it's just the reverse of that. You're trying to sell high and buy low. And that might help a lot of people who've been involved in the markets for a while, but it still doesn't really explain what's going on. And that's what I'm trying to do here. So let me give you an example. You have a goal. Yeah, a lot of us have this goal. We want to make some money. There's only one problem. You don't have any money, but you still want to make some, okay? And a lot of these, checks and what do they call it? Guaranteed monthly, that hasn't happened yet, okay? So right now, if you want some food or if you want to pay your rent, you need to come up with a way to have some money. So you think you can make some money by selling Super Bowl tickets, okay? Maybe you're a big Chiefs fan, or maybe you don't even care. You just know that the Super Bowl is very popular and a lot of people want to go. And so you have come up with this idea to sell Super Bowl tickets to someone else. You don't really care. You're going to go play GameStop videos all that day. Okay, you're not even going to watch the game, but you see a way that you can make some money. Here's a long example. You can buy the tickets you found either through a friend or online or something by going down and standing in line. That you can get those tickets for $800 each. Okay? And you have a friend, your friend Clem down the street. Hey man, I want to go to Super Bowl. Okay, and he's, I pay $1,000 for those tickets, okay? So you already have somebody lined up that you want to sell those to. So you go down And let's say when I said you don't have any money, you had $800, okay? Or maybe you had $1,600 if you're buying 2 tickets. So you go down, you buy the tickets for $800, and then you go over to Clem's house. Hey, dude, thanks, man. And then you sell those for $1,000 each. After everything is finished, your outlay was $800. You got $1,000 from Clem. You just made a $200 profit for each ticket. So if you sold 4 tickets, that would be $800. If you sold 5, it'd be $1,000. But I'm just using the 1 ticket example because maybe you like to go to the Super Bowl alone for some reason. Now here's where I hope it will make sense to you. A short example. Remember, the problem is you don't have any money? But you go over to Clem's house. He's like, yeah, man, I really want a Super Bowl ticket. And you say, well, okay, Clem, how much are you willing to pay? $1,000 per ticket. Okay? And so you tell Clem, well, Clem, why don't you give me that $1,000 and I'll go find the tickets for you. He's like, okay, man, yeah, you save me from getting up off the couch. You know, oh, by the way, can you hand me the remote? All right. So what you do is you take that $1,000 from Clem, and then you go to the place where you buy the tickets, and they're $800. And then you take $1,000 of that. You take that $1,000. You take $800 of that. You pay for the tickets. You now have $200 left over. That is your profit. You just did a short sale. You sold something first that you didn't even have. You don't own it. But you're given the money for that, and then you go out, and then you buy that for $800, and then you get to split the difference between the two. You just made some money. That is a very simple, because it is a little bit more complicated than that, but that's a simple example of a short sale where you sold first, and then you bought later. And you're happy because whether you went long or short, you made $200 per ticket. But what could possibly go wrong? A lot of things. Short selling may sound great as long as everything goes the way you want it to. But what happens if things go wrong? The pain can be really extreme. And we're seeing a lot of things called hedge funds who are not sleeping this well this weekend. They're experiencing some major pain right now. Since it is true that an investor buys at the current ask price and then sells at the current bid price, I'm just trying to review that a little bit. Stocks that have a large number of short positions have traders who have done just the opposite. They didn't buy low and sell high. You have a lot of traders, and I really hesitate calling them investors because they're really not. They're just market participants. They're doing just the opposite of that. They're trying to sell high and buy low, just like the second example with the Super Bowl tickets. So short sellers sell at the bid price to enter a position. That's what you would do if you're trying to sell your stock. Well, when they open their position, they are selling a stock at the bid price. Then short sellers, when they want to get out of it, they have to buy that stock at the ask price. And this is what makes things get crazy. Okay, and I'll get a little more into that here. So when a short seller starts to experience a loss, it's required to take action much quicker. Now, let's say you bought some stock, I don't know, last week, last year, last decade, last century, and for $10 a share, and let's say you put up $10,000 for 100 shares, or I guess that'd be 1,000, whatever it is. Let's say you put up $10,000. You know that that's all you can lose. If worse comes to worse, and you have to finally get rid of that stock, you know you're going to get some money back in case it goes, unless it goes to zero. That's when you won't get any money back. But that's as low as it can go. The worst you can do, and I know this is not fun, but the worst you can do is lose what you invested. Okay? Now that may sound like a real ripoff and not very much fun, but just give me a second to explain the alternative to that. So if a stock that is expected to fall starts to climb, you're a short seller, you get in thinking it's going to fall, but it starts going up. A short seller must cover or go in and buy so that they can cover or pay for any losses, and they have to exit that position. This means that they must buy to close. And when you buy, you're at the ask price. Okay, can you kind of see where I'm going with this? When a stock starts to run away to the upside, it's like, man, this thing's just going up and up and up and up. It's not that buyers are necessarily who are going long. It's not that they're just getting in there buying as quick as possible. It might be short sellers who are losing everything and they have to get out. But this produces a situation where the stock just keeps going up and up and up and up and up because they're executing their exit orders at the ask price. And this forces the shorts to cover, which you might hear this in the financial news or when I do my videos, you might hear this called a short cover rally or a short squeeze. These are a couple of terms that are floating around in the markets right now. So just be aware of those. That's what's going on. People that thought the stock was going to go down, it's not going down, so they're getting out, and that's pushing prices even higher. So let's go in and try to understand short selling a little bit better. So let's go back to our Super Bowl ticket example. I'm hoping that that's something that is easy enough to understand where you can take the concept from this example and then put it over into the stock market. So remember our short example. You don't have any money, but you can sell the tickets to Clem for $1,000 each. That money can then be used to buy the tickets for $800. You've made a profit of $200 on each ticket. Woo! Everybody's happy. And if Clem can get up off the couch, he'll be happy too. So what if something goes wrong? What could possibly go wrong? The people that have these short positions right now, they're the elites. They're the big money. They're the ones who supposedly manipulate the market and make things go the way they want them to go. How come they're panicking right now? Well, that's what we see being played out right now. Instead of the Super Bowl tickets costing $800, let's see, you went over to Clem's house. Before you left your house, the tickets were $800. You get the $1,000 from Clem, but then your heart sinks when you go to buy the tickets, and now they cost $1,200. Oops. Okay? You've already sold the tickets to Clem for $1,000, but now you have to buy the tickets for $1,200. You now have a loss of $200 on each ticket. So something changed in that amount of time, and things can change quickly, like what we are seeing in the stock market. But in all areas of life, things can change really fast. So what if the price then, by the time you got down there to buy the tickets, what if it went to $2,000? Okay, you brought in the $1,000 from your friend selling the tickets, and then you subtract the price that you have to pay. If they're $2,000, you have a $1,000 loss. Okay, things are not looking very good for you right now. What if you get to the place to buy the tickets and they're $3,000 each? Now, this is only if the Seattle Seahawks are in the Super Bowl because they're the best team. And naturally, people would want to pay a lot of money to see them. Okay, for those of you that don't know, I'm from the Seattle area and I like the Seahawks. Okay. So now you have a $2,000 loss. The $1,000 you took in and then the $3,000 that goes out. You take the difference between the two and you have a $2,000 loss. There's really no limit. Okay, when you're long a stock, how low can it go? Zero. Unless you're oil or something that actually went negative there for a while. Unless your interest rates in Japan sometimes, and in Germany right now where they actually go negative. Those are weird things that are kind of beyond what I'm talking about right now. But as a stock owner, it can only go to zero. It might trade 1 cent a share, but it hasn't hit zero yet. So that's as low as it can go. But how high can a stock go? Nobody knows. The sky's the limit. Well, there is a limit to the sky, but it could go to anything. It's whatever investors are willing to buy and sell. That's the price. So there's no limit. As long as somebody is willing to pay a price, it's like, why do these, it kind of makes me not angry, because there's a lot of other things to be angry about, but when they pay these sports stars, these athletes, all this money, they get mad at the athlete. And I'm like, why? The owner, they're the one that you should be mad at. They're willing to pay that price. If you're a good athlete and you can make really good money, why not? And they're willing to pay you $10 million a year, go for it. If the owner is willing to do it, that's the person that's really saying yes or no to the deal. It's not the athlete necessarily. So whatever the price is, that's the right price at that moment. And now prices are always changing. And so it might be the right price at this minute, but 10 minutes later, that might be the wrong price. And then the bid-ask shifts and prices trade either higher or lower just a few minutes later. But whatever the current price is, that's the right price. We have to follow price, no matter what it's doing. Even if all of our logic says something should be going up and it's really going down, doesn't matter. You have to follow price and act accordingly. So what has happened in this example is your clever idea has backfired. Maybe that wasn't such a good idea after all. Now, there's some people that really hate short sellers. Or they may, if they've even heard of short selling, they know just enough about it, kind of like in today's world where people know just enough to either really like or not like something without really understanding it. There are people that really hate short sellers. So, a few reasons why, and I just came up with this list myself. There might be even more than this. It's harder to understand. Like I said, I have to do a video about this just because there's a lot of people that don't understand it. I had an 8-hour conversation, and the person still didn't really understand what I was talking about. They did a couple days later. It took them a little bit of time, and they were rolling around in their head the things I was saying. And then they came back to me and said, I get it. Yaha, woohoo. Okay? And it might be that way with you. But a lot of people don't understand short selling. So they just like, well, at least I understand going long, buy low, sell high. That's not all that hard. So when you are a short seller, the financial requirements are massive. When you can't do like you did with Clem, you can't take his $1,000 and run out and go do it. No, when you short stock, the money that you get has to stay in your account. And not only do you have to have that money stay in your account, you have to have a bunch extra money in your account in case things do go wrong. And a lot of this came about because of the 1987 crash, where a lot of shorts were caught and they didn't have the money in their accounts. People were losing their houses, their businesses, their cars, because that has to be repaid. And there's no, well, I can't do it right now. You can't be the federal government and just, here's too much money. Let's just create it out of nothing. Or modern monetary policy or modern monetary theory. Okay? You can't do that as an individual. The government can, but you can't. Okay? The financial requirements for all of the players, whether they're hedge funds, mutual funds, individual investors, the big boys, the pension plans, the 401k folks, they have to play by these rules. And if they decide to go short on something, they have to have the money behind them in case things do go wrong. Then you can lose more than your investment. Do you remember a minute ago I said that if you buy a stock at 10, as low as it can go is 0. Well, what's as high as it can go? Nobody knows. It could just go to infinity and beyond. Okay, I said that a little different than the movie, but still, there's no limit. That's what makes the stock market a very good enticement for a lot of people is you can buy a stock at $1 a share, and a number of years later, it could be $100 a share. There's no limit. You don't know where it's going to go. But you can, when you're short, You might invest $1,000, but you might end up losing $10,000 or $20,000 or $100,000. And it can get really nasty and really ugly really fast when you're a short seller. Now, there are some people, and I understand this, folks, the idea behind the stock market, when you take your hard-earned money, well, or some people take their money that they got in the mail from the government, and which wasn't really hard-earned, but you're still paying for it. No matter what they say, nothing's free, okay? But you take some money, however you came about that, and you put it into the market betting on the future of that company. And I don't like the word bet. Wall Street can be like gambling, but if you play it right, you can remove most, if not all, of the risk. And that's what I teach people how to do. But anyway, you might think, well, these guys that are making money when something goes down, that's not very American. That's not very patriotic. We shouldn't be allowed to do that. And there are some people that feel that way. And if you do, it's okay. It's okay. So you don't feel bad about that. Or some people think that's even unethical. Oh, you shouldn't make money when other people are suffering. Well, there are market cycles. There's a time for everything. And the birds, to everything, turn. Okay, never mind. The markets go through cycles. And there's a time for it to go up, there's a time for it to go sideways, and there's a time for it to go down. And some people think that going down part, with all these other people suffering and maybe losing their retirement or a good portion of their retirement, that's not very nice, and I don't want to be a part of that. Okay, if you feel that way and you're strongly convicted about that, I can totally respect that. But if you're also a person that realizes this is a fact of life, that there are cycles, that there's a time when the market goes up and there's a time when it goes down, and I want to be able to take advantage of both. If that's how you feel, that's fine too. It's where do you stand, and don't let the media tell you what to do. Don't let all these, think for yourself. You decide if you think this is patriotic or unpatriotic, or if this is ethical or unethical. Don't let somebody else tell you. You make up the decision yourself. You're smart. You got a brain. Use it. Okay? All right. So you may think that short sellers are the ones who drive stock markets down. Now, looking at my example, what do the short sellers have to do to get out? They have to buy. So when they go to take their profits because they have to deal with their losses, they have to buy. Now, it's true that when they entered their position, they did so at the bid price. And if a whole lot of them are doing it, yeah, that can drive things down. But to think that something continues to go down and is in a free fall, and it's the short sellers that are causing it, that just means somebody doesn't really understand what's going on that uses that example. It's usually the people that don't know what's going on. They're the panicked ones, right? At that point, they're the ones going in and selling and driving everything even lower. So be careful if you use that as an argument. It doesn't mean it's not true. It just means it's not necessarily the whole story of what's going on. So, if you've ever heard this cliche that we use, don't sell yourself short, you probably use it all the time. We get that from this. When you short sell the market, that means when you sell yourself short, that means that you might be good at something, but you say, it wasn't that good. You're selling yourself short. You're talking yourself down at that point. You're not claiming to be as good as you really are at that point. So we get that cliche that we use in English. So when you're looking at an investment, it can be very wise to actually look at the short interest ratio, or simply called the short ratio. And there's going to be a certain percentage of the stock that a company makes available that some investors, for whatever reason, decide to short that company, where they're going to benefit if the price goes down. And there's stocks that people buy hoping it will go up, though they are long, and that's usually the higher percentage. And then there's a percentage of people who think the market, that stock will go down, and so they short the stock. And they take that and put it through a mathematical calculation, and you come up with what is called the short interest ratio. I'm not going to talk about how that's calculated. I just want to explain the concept. So typically, this is measured in terms of days to cover. Okay, what does that mean? Well, days to cover measures the expected number of days to close out all of those short positions in a stock. So if it has a 3-day day to cover short interest ratio, that means with the amount of shares based on the average volume that usually trades, it would take 3 trading days for all of those shorts to disappear. And then this gives you some kind of a number. And when you're buying a stock, you usually want to have a lot of short interest in that stock. Why? Because you have built-in buyers. If things go the wrong way, they have to come in and buy, and that's going to push prices even higher. So you want a stock that has a high short interest ratio, if you can. That shouldn't be the only reason, but it can be a reason that you use to get into a particular stock. So the higher the number or ratio, the more built-in buyers there are on the sidelines that must come in and buy or cover their short positions if prices go against them. So they have to watch these things with all those financial requirements and how things can get really out of hand really fast, where you can lose more than you invest. If the people that are in short positions, they can't just go hit the beach. They have to keep an eye on things. And they're waiting on the sidelines, and if things go desperately against them, they have to jump in and buy in order to close out their positions. So when they must act, this is then what we often call a short squeeze. They didn't want to get in and buy or close out their positions. They had to get in and buy to close out their positions, which when we see this happening, and sometimes when I do my daily videos, I'll say, yeah, the market really shot up at the end today. I think that was a short squeeze that happened because there's a lot of frenzy buying going on at this point. And people are buying not because they want to, but because they have to close out their short positions. And this can really make prices go up fast. So thank you very much for watching this video. I appreciate it. And please feel free to subscribe to this channel and leave a comment. And don't forget, there are other videos right here that you can watch for more useful information about the stock market.